Hi everyone. Hopefully you guys are doing well. Uh, Welcome to another session of Advanced Performance Management, right? Uh, and in today's class, we're gonna be discussing some particular topics that you might not have studied already, but the thing is they are important, right? So we need to study that as well. Huh? The thing is that they are important, and therefore we need to study that as well. So, sir, what are the topics that we are going to cover in today's class? They are basically what I'll say is additional performance measures, right? So far, you guys have studied. So far, you guys have studied the performance measures, but now I wanted to teach you the additional performance measures that can be asked, right? But I wanted to teach you the additional performance measures that can be asked, right? So far, what you guys have done is you guys have covered risk and uncertainty, right? You guys have covered sensitivity analysis and expected value, right? Uh, we have covered the hierarchy and we have covered the basic performance indicators, right? We haven't covered the additional performance indicators yet. So therefore, we have to look at that. Huh? So therefore, we have to look at that. Right? And then we attempted several past papers also, right? We calculated NPV, we calculated probability analysis, and yeah, then we attempted a particular past papers, right? Then we attempted a particular past paper, that's the Superior Software House. The Superior Software House. So this was a brief revision, and we commented on each and every performance indicator. And we commented on each and every performance indicators. See, these comments are very important and they can be asked frequently, right? These comments are very important and they can be asked very frequent. So therefore, what I believe is that you must have got enough drafting and see the pattern that you should be studying in. The pattern in which you should be studying in is simple. And what's that? That any past paper that we have covered, right? A tip for each and everyone that any past paper we have covered, make sure you read the examiner answer, right? You read the examiner answer of that as well. Right? You read the examiner answer of that as well. And why is that for? For extra points, right? Why is that for? It's for extra points, okay? It's for extra points. So the thing is that whatever past paper we do, you make sure that you make sure that you have covered the past papers examiner answer as well. And what you guys say is that's a we cannot write like examiner. That's totally fine. You cannot write like examiner. But the thing is, you will get some extra points. And then you can uh, attempt well while attempting the answer in your mind there will be some extra points, so that can give you some extra marks. Examiner knows you cannot write like that, and in fact in some papers examiner write that we cannot expect a student to write like us because he or she is in the exam pressure, right? He or she is the exam pressure, right? So the thing is, but again, reading an examiner answer would allow you to gather some extra points. Well, agenda that we have to cover in today's class is simple. That first we have to cover the EBITDA. First we have to cover. Now we are discussing the additional performance measures, or I can say the advanced performance measures, huh? Or I can say the advanced performance measures. Now we are going to cover that. Huh? So EBITDA, right? So EBITDA we need to cover. I'll teach you what is EBITDA. Then we need to cover the NPV as well. Huh? We need to cover the NPV as well. So far, you guys have been explained NPV or have been allowed to calculate NPV, but haven't been given a brief idea that how NPV work here, right? So I'll give you an idea of that as well. I'll give you an idea of that as well. Mainly, NPV is complex, right? Mainly, NPV is complex, but in AFM. In AFM, the NPV has some complex issues. But in APM, it's quite simple and it's more descriptive rather than calculative, right? In APM, it's more descriptive, right? Rather calculative. So in AFM, if someone is doing AFM also, they know that there can be a calculatory complexity. But in APM, I don't think so that there's any particular complexity of this. There is any particular complexity of this particular topic. So we're gonna be having an eye on NPV as well. Huh? We're gonna be having an eye on NPV as well. And yeah, the advantages and disadvantages. Huh? And yeah, the advantages and disadvantages. Yeah, you'll get this PDF, no worries on that. Huh? One of the student has texted, so this PDF completely is uploaded on LMS with the past papers, with the technical articles, so don't need to worry. Huh? So advantages and disadvantages is done. Then what we have to do, we have to study IRR as well. Huh? We have to study IRR as well. We'll have some examples of IRR. We'll have some examples of IRR, and then again we have advantages and disadvantages. Now, why is that? Because in P5 or APM, these are additional performance measures, and they are used to measure a particular performance. So, since you are using the financing indicators, what you have to do, you have to explain these additional performance measures also. A candidate can be asked, right? Candidate can be asked to analyze these points, huh? Can be asked to analyze these points, okay? So therefore, it's important, huh? So therefore, it's important that you look these factors as well, right? Then we're gonna be having an eye on modified internal rate of return. Huh? Then we're gonna be eye on modified internal rate of return. Okay, so we need to look at that as well. Modified internal rate of return. That's not covered previously in PM or in A or in FM. They are not covered, right? The modified internal rate of return. So we're gonna be having a discussion on it as well. Now, this is also a performance measure, but additional one, right? This is also a performance measure, but additional one. Okay. Any questions still here, guys? Now, this is particularly the criteria that we have to go through, right? This is particularly a criteria that we have to go to, right? Then non-financial performance indicators as well, huh? Non-financial performance indicators. We have to look at that as well. This is a small topic. And after that, difference between, yeah, we have to discuss a difference between performance management and performance measurement. So we have to discuss this as well, the difference between performance management as well as the performance measurement, right? So we're going to be having a look at that as well. And after that, our topic of additional performance measures will be done, right? And after that, our topic of additional performance measure will be done. An important note here is that in P5, right, in APM discussion from the business consultants, right? In APM, there is a discussion between business consultants is expected rather than calculation, right? Rather calculation. So calculation is not expected, right? But discussion element is calculated or discussion element is tested, right? But to discuss a particular case, there should be strong grip on calculation, right? So without calculation, you cannot discuss, right? Like if I ask you to analyze any performance, you should have a good grip on calculation. And once you have a good grip on calculation, then you can explain the numbers well. So anyone who haven't been gone through the calculation cycle cannot comment on it, right? In order to become the business consultants, right? What this paper aim is that to make you the consultants, you need to go through the calculation and then you need to go through the expertise and then you need to go through the expertise of analysis, that how you're going to be analyzing the situations. So students kindly texting me regarding that, sir, we have too much focused on the calculation as well. The thing is that without the calculation area, you won't be understanding these techniques, right? You won't be getting NPV, you won't be getting IRR if I didn't get you the calculations. So if you're not getting a particular technique, you cannot comment on it. APM depends on the analysis and the consultations and the commenting and all that, right? But you need to have a good grip on calculation to correctly analyze a particular number, right? So therefore, I've designed this course like this, like for every particular topic, we gonna be commenting a lot, right? We're gonna be commenting a lot and we're gonna be practicing a lot as well, right? We'll be solving complete questions and then analysis and the comments and all that, so that your drafting gets increases, right? But without focusing on calculation, you cannot draft an answer. Kindly remember this, that without focusing on calculation, you cannot draft an answer, right? Kindly remember this. Okay? Any questions here, guys? Shall we start our first topic? Shall we start our first topic? Yeah. So let's just start with EBITDA, right? Let's just start with EBITDA. Okay. So what's EBITDA, sir? Right. Let's just start with EBITDA. That what is EBITDA? Okay. And how it could be a good performance or additional performance indicator, right? So let's have a discussion on it. See, EBITDA means earning before interest and tax less depreciation and amortization, or add back depreciation and amortization. So EBITDA stands for earning before interest and tax, okay, excluding, or you can say including as well, depreciation and amortization, okay? Depreciation and amortization. So EBITDA stands for this. Now, the problem here is that why we need EBITDA, right? The problem here is that why we need EBITDA. So kindly let us know that why is this considered an alternative performance measure, huh? Why is this considered an alternative performance measure? So the thing is that sometimes organizations have higher depreciation and amortization amounts, right? Sometimes organization have higher depreciation and amortization amounts due to heavy machinery, heavy plants, heavy equipments. So working on EBIT or the operating result doesn't give that much true picture because depreciation and amortization are accounting expenses. They are not the real expenses, right? I guess you didn't understood. Huh? I guess you didn't understood. So let me explain it again. See, if there is a higher depreciation or amortization due to heavy machinery or or particularly due to heavy plants, right? So there will be higher depreciation and higher amortization, right? So there's gonna be higher depreciation and higher amortization. So EBIT, so EBIT would not be an accurate reflection. EBIT would not be an accurate reflection of performance, right? Because in EBIT, what happens in EBIT, depreciation, EBIT, and we also say EBIT as an operating result. Like many of you are working in an organization, so you might not be seeing EBIT, but you will be seeing operating result. They both are same thing. So operating result have depreciation and amortization being deducted, right? Depreciation and amortization being deducted. So it's not an accurate or accurate reflection of the performance, right? It's not an accurate reflection of performance, right? So what we do here is, that we add the depreciation and amortization back. Why? To nullify the impact of these heavy plants and heavy machinery, right? So to nullify the impacts of these heavy plants and heavy machinery, what we do is we add back depreciation and amortization. Huh? We add back depreciation and amortization. So what happens is that you get accurate performance of your business. Huh? So what happens is that you get accurate performance of your business. Huh? So you'll get an accurate performance of your business here. Huh? So you'll get an accurate performance of your business. Now, for example, if you're starting from EBIT, or we can say operating result, right? So what you'll do, you'll add back depreciation. You'll add back depreciation and amortization, right? So you added it back and you got EBITDA. Now, one student asked us, sir, if I do not calculate, or in my organization, we do not calculate EBIT. We work on net income. So what you have to do, like in your organization, if there is a net income, what you have to do, you have to add back what? Depreciation, okay, amortization, okay, interest as well as tax, right? So from adding interest as well as tax, you'll arrive on EBIT from net income, and then depreciation and amortization, you'll arrive on EBITDA. And once you'll add back all these, you'll arrive on EBITDA. Now it depends on your organization that what you follow. Since I have a corporate experience, right, of 4 or 5 years. So in our organization, EBIT is also calculated and EBITDA is also calculated and reviewed. And it's considered as one of the key performance indicators. It's considered one of the key performance indicators, although it's an additional performance indicator, but we considered it as a key, right? But we considered it as a key. Okay. I hope you have got this pointer. Now, so advantages of calculating. Now, so advantages of calculating this particular KPI. Yeah? Advantages of calculating EBITDA. See, it's basically a substitute of cash flow, right? Substitute of cash flow. Now, cash flow seems to be more accurate reflection in an organization. When you see cash flow, it seems to be more accurate reflection, right? It gives you more accurate reflection of an business, right? It gives you more accurate reflection of an business. So in organization, if you don't have cash flows, you can calculate EBITDA as it's a substitute of cash flow as non-cash expenses, as non-cash expenses have been added. So I believe EBITDA can be termed as a substitute of cash flows, right? Substitute of cash flows. Similarly, non-operating external cost. See, your non-operating external costs such as interest and tax, such as interest and tax, they have been added back, right? So added back, that means now EBITDA gives an performance of operations. Now EBITDA gives you the performance of operations. Now it doesn't have the impact of interest. It doesn't have the impact of tax. So someone can argue that our profits are low because of interest and tax. So kindly eliminate that and see the performance of operations. So ideally, your operations should be performing well. Ideally, your operations should be performing well. Like if some manager are giving an argument, that our performance is not as per the budget because of interest and tax. So you will counter argue, now remove that, calculate EBITDA, please. And they'll calculate the EBITDA, and then EBITDA will be compared with budget, that whether you are on budget or not. See, since I have worked in the developed economy, I have worked in a developed economy industry. So there we have significant fluctuations in interest and tax, and sometimes they impact 10%, they add 10% extra tax. So the problem is that here the profits and the net income cannot be a good KPI because they have a huge impact of interest and tax. So EBIT and EBITDA seems to be a good one, as they have not included interest and tax. So it could be a good. So I'll say EBITDA can be termed, EBITDA can be termed as a good indicator of operational performance, right? EBITDA can be termed as a good indicator of operational performance, right? EBITDA can be termed as a good indicator of operational performance. Now, controls major decisions. Now, so how EBITDA can control a major decision? So how can EBITDA control the major decision? Can you tell me how EBITDA can control the major decision? So see, EBITDA can control the major decision. See, EBITDA can control the major decision. How so? It's just like if you're expending, it's just like if you're expending your products or markets, right? If you're expanding your products and markets, right? And the thing is that if you're expanding it and your business performance, your current business performance can be monitored through EBITDA, right? So you can decide. So now you can decide whether we have to expend, in we have to expend in same business or not. Now you can decide like here, huh? You can decide in here, and why you can decide it, because in the same business you have an EBITDA, and if you have operations being running great, if your operations are being running great, so that means you don't need, or you need to expand it more, because now see, there is one particular indicator that reduces the interest in tax and each and everything, that closes up the interest in taxes and each and everything, right? So that indicator would allow you to give you the exact business potential, to give you the exact business potential, that whether your business has a good potential or not, that whether your business have a good interest or business potential or not. So if yes, if the EBITDA is good, then you can expand in the different economies, you can expand in the different product lines, you can expand in the same product lines in the different economies, right? Because you know that our business in this economy is going well. So is considered, EBITDA is considered a good performance indicator that reflects the business performances, right? So it's the advantages, the several advantages that we have given you to explain the EBITDA. If there are any questions, you guys can ask. Again, the strategy of mine is same. Again, the strategy of mine is same. And what's that? It's simple. At first, I'll teach you the topic and the topics, and then I'll take you the past papers, and then we'll solve the past papers on exam platform as well. I'll teach you the topic, and then I'll go on to the past papers, and then we'll go and explain the past papers on the exam platform, right? Any questions if there are, you guys can ask. Any questions if there are, you guys can ask. Otherwise, we can move on to the next topic. Otherwise, we can move on to the next topic.